Central Counterparty, CCP. Concept, types, alternatives, and implications for investors. 1. The different types of CCPs. Central Counterparty Clearinghouses, CCPs, are institutions that act as a centralized counterparty in over-the-counter OTC derivative transactions. Their main function is to mitigate counterparty risk, that is, the risk that one of the parties in a transaction will not fulfill its obligations. There are different types of CCPs, classified mainly according to the type of derivative instruments they clear. Fixed income CCPs. They specialize in fixed income derivatives, such as interest rate swaps and bond futures. Foreign exchange CCPs. They focus on foreign exchange derivatives, such as forwards and currency options. Commodity CCPs. They clear commodity derivatives, such as futures on oil, metals, and agricultural products. Equity CCPs. They are dedicated to equity derivatives, such as stock options and stock index futures. 2. Benefits of using CCPs. Using CCPs offers several benefits for both market participants and overall financial stability. Counterparty risk reduction. By centralizing transactions, CCPs significantly reduce the risk of default by one of the parties. Increased transparency. CCPs provide more complete and transparent market data, which contributes to a better assessment of risks. Increased efficiency. CCPs automate many of the clearing and settlement processes, which reduces costs and increases market efficiency. Financial stability. CCPs contribute to the stability of the financial system by mitigating systemic risk and reducing the possibility of domino effects in the event of default. Alternatives to CCPs. While CCPs are considered the best practice for mitigating counterparty risk, there are some alternatives. Bilateral clearing. In this model, the parties enter into bilateral obligations with each other, without the intervention of a CCP. However, this method exposes the parties to greater credit risk. Central Counterparty Clearing and Settlement Mechanism, CCCSM. It is a mechanism similar to a CCP, but with a different legal and operational structure. CCCSMs are often used by stock exchanges to clear listed derivative transactions. Implications for investors. The use of CCPs has several implications for investors. Higher costs. Investors must pay fees to CCPs for their services. Margin requirements. CCPs impose margin requirements on participants to ensure that they can meet their obligations. Central counterparty risk. Although CCPs reduce individual counterparty risk, there is a risk that the CCP itself may default. Less flexibility. The use of CCPs can limit the flexibility of investors by standardizing products and trading processes. In short, CCPs play a key role in managing risk in the derivatives markets. Although their use involves certain costs and limitations, the benefits in terms of counterparty risk reduction and improved transparency far outweigh these drawbacks. At ILP, we are experts in advising companies and startups, especially in financial regulation. Our goal is to support your success and growth. Get in touch with our AIs, Savvy and Atenea, to focus your inquiries, or contact us directly. More information at ilpabogados.com and ilpstartup.com.